You've got to add this stock to your watch list ASAP. Its industry is expected to grow by 26% over the next 7 years. It's an intriguing turnaround play as an investment, and it's a high growth business that seems to be trading quite cheap. Let's do it. My name is Matthew, and today the stock we're going to be looking at is called Next Green Wave, ticker NXGWF. Big fat disclaimer here, this is a very risky stock. This is not a recommendation to buy. I am not being compensated to analyze this stock. I am in no way affiliated with Next Green Wave, and I do not own any shares of this stock right now at the time we're recording this video, and I do not plan on initiating a position anytime soon. So if that's the case, why make this video? Well, I simply want to share my research on this stock so far, because I do think it's interesting up until this point. So I'm simply sharing my DD. I'm not buying this stock. And now we've got that clear, we can move on. You see, Next Green Wave trades on the OTC markets, and it's essentially a penny stock. It trades at roughly a $50 million market cap, which is very, very small. It's a micro cap. And normally I would do anything to avoid talking about penny stocks. I am fully aware of the BS pump and dump videos that are out there that have no regard for your hard-earned money. And actually the last and only time I discussed a penny stock on this channel, it turned out to be my worst performing investment I had ever made. It dropped nearly 80% since then, and I do feel very responsible. And yes, I do still hold that position, and I plan to make a full video reviewing all the lessons I've learned from that failure. And it's not like I failed to do actual research on that one. I made a legitimate effort, but that's why these penny stocks, these OTC stocks are so risky. And this time is different, are always famous last words. However, Next Green Wave is profitable. They have a solid balance sheet and no debt. They have a promising turnaround plan, and it's a pretty high growth industry. No pun intended. So if I haven't scared you off by now, I'm assuming you understand the risks, so let's get into it. We'll start with a quick overview of the business and why the stock recently tanked after Q2 earnings. Then we'll go into the main thesis and the catalysts and the valuation, and finally the risky risks involved and what I'll be doing moving forward. But first, a quick message from the sponsor of today's video, Masterworks. Masterworks is a platform that lets you invest in one of the best performing alternative asset classes of all time, contemporary art. Contemporary art has outperformed the S&P 500 by nearly 3x since 1995, yielding an annual return of 13.6% over this period. This means that $1,000 invested in contemporary art in 1995 could be worth $24,230 today, while the same amount would just be $8,420 in the S&P. Now, although past performance does not guarantee future results, these results are pretty impressive to say the least. And fine art hopes to keep up with these stunning returns. It was just named one of today's hottest markets on earth by the Wall Street Journal, as auction houses recently shattered records, with $2.3 billion worth of art being sold over the course of just 2 weeks, and items selling for 10 times their asking price. And that's probably because the wealthy have noticed that inflation has officially surpassed its peak from 2008. You see, not only does art outperform, but it can be a very effective hedge against inflation. Typically, only the ultra wealthy have access to this exclusive asset class, but with Masterworks, people like you and me can invest in multi-million-dollar paintings from famous artists like Picasso, Andy Warhol, and Banksy. I have personally invested in Basquiat's all-colored cast because he's arguably one of the most stable artists on the platform, with similar works appreciating at 22% per year. To invest, I simply selected the amount of shares I want to own and pressed buy. Now I can wait for the painting to be sold, or you can sell them in the secondary market just like stocks and crypto. If you want to start investing with Masterworks, usually there is a waitlist, but I was able to get all of you a link to skip that waitlist down below in the description. So if you want to get started investing with Masterworks right away, check out the link below. Alright, now let's get back to Next Green Wave and their business overview, why they recently tanked, and what's the turnaround story here. They are a vertically integrated producer of premium cannabis flower and extracts. They're primarily a wholesaler, which means they grow premium flower and then sell it to a retailer who then marks it up and sells it to consumers. But they also generate revenue from dispensaries, distribution, and manufacturing. They have an exclusive genetic library of 100 plus strains, a portfolio of highly recognized brand partners, and Next Green Wave branded products, and they've also established a world-class nursery through innovative tissue culture research. Right now, they operate a 35,000 square foot production facility they call Facility A. In the future, they plan to build out Facility B, C, and D, of which B and D will be massive production facilities. B is starting at 62,000 square feet, just under double the size of Facility A, and Facility D expects to be 250,000 square feet, which is over 7 times as large as Facility A. So again, Facility A runs the show right now, but B, D, and C are coming, and we'll get to those later in the video during the catalysts. As of now, their competitive advantage as a business seems to be the superior quality of their product and also their financials, which I'll also get to later. In fact, their premium stuff is so good that their main wholesale customer, a retail brand named Cookies, wants to keep their strain with Next Green Wave exclusive. How? Well, when Facility B is finished, Cookies plans to reserve 25% of Facility B's capacity just for Cookies stores. And for some more color here, Cookies is a popular retailer with roughly 29 locations. So with all this going for them, why did Next Green Wave stock drop 50% since Q2 earnings? Well, in Q2 there was a huge revenue drop that blindsided investors. They dropped from 4.8 million of revenue in Q1 of 2021 to 3.5 million the next quarter. Meanwhile, investors were expecting solid growth, and instead they got this big fat drop. Next Green Wave could have easily maintained revenue growth, but management made a tough and very impactful decision behind the scenes, which ended up causing this drop in revenue and leaving investors shocked. So what was that decision? Simply put, management recognized that their margins for their edible products were being compressed. They were going down. So then the question became, why focus our business operations on a segment like edibles where it's only going to become less and less profitable over time, where instead we could actually allocate those resources back into our premium flower, which is our core product. It still has great margins and it's our biggest differentiator. So they kind of abandoned their edible segment and went all in on their premium flower. So that was the reason for the drop in revenue, and the drop in stock price was because, again, they completely blindsided investors with this move, and management seemed to give no warning that this would happen. That said, there may be a mini turnaround opportunity here. Not only are they focusing more efforts on their more highly profitable and differentiated product, but they're also kind of pivoting to a more direct-to-consumer or DTC business model to capture more revenue along the value chain. Instead of simply remaining a wholesaler and selling to a retailer like Cookies who marks it up and sells it to the consumer, why not directly sell to the consumer yourselves and capture way more money? To do this, they're pursuing the acquisition of retail locations and have an ambitious goal to become the top 5 integrated premium producer, brand, and retailer in California markets. Some of their Q3 numbers were actually pre-released, and they just officially released their numbers on Cedar moments ago. Revenue's already climbed back to where it was before the Q2 debacle, and they're seeing gross margins of 59% in this past quarter if you account for fair value adjustments. In Q1 of 2021, before the Q2 pivot, they saw 64% gross margin. So they're not quite back to where they were before, but they're really not too far off, and I wouldn't be surprised if they're back to where they were in Q1 by the next quarter. And it's still better gross margins than the 48% they realized a year ago in Q3 2020, if you account again for fair value adjustments. And this is the perfect segue into their financials, which is part of the main thesis, the catalysts, and we'll also touch on the valuation. So as I said before, their financials are actually a competitive advantage in my opinion. Because of the numbers I'm about to show you, they have incredible optionality and lots of cash to reinvest back into their business. This will not only allow them to aggressively attack this new pivot to DTC, but it also gives investors hope that they will not dilute shareholders to raise capital like many microcap companies do. Starting with their balance sheet, I mean, it's absolutely bulletproof. They are debt-free and literally have a mere $732,000 in total liabilities. And this is actually kind of ridiculous. I mean, I hope liabilities don't stay this low for too long, because I'd rather have them at least use some sort of leverage to fund or facilitate investments such as Facility B, but still. This shows you what a strong position they're in right now and also gives you the confidence that they won't dilute shareholders in the near future. They also already have $4.9 million in cash and $1.6 million in receivables, and overall this balance sheet is a fortress right now. And on top of that, their income statement and cash flow statements aren't too shabby either. Starting with their income statement, their operating expenses have also dropped notably, and that's a good thing because it's an expense, we want it to be lower. In Q3, they had total OPEX of $467,000 versus a year ago's $956,000 in operating expenses. And if we compare it to Q1 of 2021, again, the quarter before their brutal Q2, this past quarter's $467K in operating expenses is a huge drop from Q1's OPEX of $704,000. Net income for the quarter would come in just under $1.5 million. Now, it's not quite back to Q1 2021 numbers, but as usual, it's close. And $1.5 million is still an annualized run rate of roughly $6 million in net income per year, and this is where we get into valuation and catalysts. So if Next Green Wave has a market cap of $50.3 million today, which it does at the time of recording this, and that's in USD, $6 million in annual income is a forward PE of 8.3. If we get Facility B up and running, with today's net income margin of about 34% and Facility B being about 1.7 times larger than Facility A, we can start making some very conservative but helpful estimates. Okay, so let's assume Facility B generates the same amount of revenue as the company does today with Facility A alone, and that's $4.3 million. This is obviously relatively conservative, and let's say that Facility B in particular has a net profit margin of 20% versus today's 34% for the company. So that would create an additional $860,000 per quarter in net income, or $3.4 million in annual income. That brings us to a total of $9.4 million in annualized revenue, assuming zero growth from Facility A as well, and zero growth from the direct-to-consumer pivot. At a $50 million market cap, we're looking at a forward PE of roughly 5.3. Now that's assuming, again, a $9.4 million in net income, and in my opinion, that might be able to come sometime around the end of 2022. Now, in all fairness, it could be longer because Facility B was already delayed 9 months so far due to supply chain issues, but either way, Next Green Wave is actually starting to look pretty cheap. And I didn't even mention their incredible free cash flows, which can be used to service debt or reinvest back into the business. And I also didn't expand on facilities C and D because that's an area where I need to do more research. And by the way, if you want to know exactly when I make a trade and also see more in-depth videos, more in-depth than this one on a bunch of different stocks, then go ahead and check out Investor Community down below in the description. Our Black Friday sale is still going on. Use coupon code FRDY to get you 15% off our 3-month and annual plans. We just posted our schedule for December, and we're super excited to see you there. Now, as far as the risks go and what I'm doing, I'm actually not that big on the cannabis space. I know it's a growing and huge potential industry, but I don't know much about it and it doesn't particularly interest me. Therefore, I'd have a lot of catching up to do if I'm to research this stock further, such as legislation for the Safe Banking Act, legislation regarding selling across state lines, barrier to entries for competing premium flowers, and what is a competitive advantage or moat for Next Green Wave. And as far as particular risks based on what I know, there are potential for continued delays of Facility B. They already delayed it 9 months due to supply chain issues. Revenue concentration risk with Cookies, one of their largest customers, wholesale customers, although I don't think this is much of a big concern because it's obvious that Cookies loves Next Green Waves. That's why they reserve 25% of Facility B. And there's also trust and transparency with management. You know, they dropped a bombshell in Q2 without telling any investors ahead of time and left a lot of them holding bags down 50% from that Q2 report. Obviously, that created this buying opportunity, but now it leads to the next time we have to trust management where they say they won't dilute shareholders, but is that really true? Now, you can also look to the balance sheet and the cash flow statement to see that, yeah, there is no reason why they would need to dilute shareholders, but again, it's a lot of speculation. Now, what am I doing? Obviously, this stock is a micro cap. I want to know I can trust management more. It's very volatile. It's outside of my circle of comfortability, I'll call it. And much of the value unlocked for this 5 to 10x upside will only come as quickly as the facilities are built, in my opinion. In that case, I would want to wait to see Facility B near finished. Otherwise, they're still constrained to Facility A. And finally, the financials and numbers look fantastic. But the business and the space is yet to really spark my interest. I want to make sure I invest in companies that I can't wait to learn more about. And so for now, mostly due to my limited knowledge of the cannabis industry, I'm not buying in, but as I do more DD, things may obviously change. So thank you again to Masterworks for sponsoring this video. Check out their link below to invest in fine art, and also use code FRDY, our little ticker symbol for Friday, at checkout for 15% off your first 3-month or annual IC membership. Join while you can. Subscribe.